Hey everybody, Brian here from quantlabs.net. I'm going to show you how I've got the final scripts and applications that will acquire data from the U.S. government through the Federal Reserve, the St. Louis Fed. This is the kind of data we're going to grab. We're going to grab the PMI from the ISM, grabbing the University of Michigan Consumer Sentiment, building permits, housing, I think it's completed we look at, durable goods. We could also grab the durable total new orders, shipments, so on and so forth. We can grab all this stuff. We grab the unemployment rate. We also grab the industrial production index, the continued claims, insured unemployment, and the money supply. This is all for the U.S. So if you have not seen my European, how I can acquire all the data from Europe, I can do the equivalent for Europe, and I also can break it down by country. Late last week, it came to a point where if I, let's say, focus on one market, Italy or Sweden, which I showed, ran the micro analysis on the different types of stock selection for my risk assessment, my parameters and metrics that I want to use, they're not good enough. I don't feel comfortable trading out of regions that don't have stocks that offer any kind of guidance or any kind of option data to show liquidity. I see no reason to do that. I have looked at UK. There are a few that offer that data. Germany is another one that may be worth looking at. I have looked at Germany in the past, and it's not a pretty picture when you look at all the wonky unknown companies in that region as well. So as it stands right now, I will be focusing, of course, on US for pretty well all my equity trades for at least for this time starting out. So that's the data I'm looking at, and it's just to give me a view of the American economy, and I will show you how we grab an example of how we grab a typical data point. Okay, so this is the ISM manufacturing PMI. Here it is. Boom, boom, boom. Let's come to the Fred, like I said, the St. Louis Fed org. And you'll come into these charts. You just do a simple Google search on Fred of this, let's say, or whatever data point you want. Come under View Data. And what it'll do is it enables you to have all the text files available of those URLs. Now, I try to rework it in MATLAB, but the download honestly, it was a pain in the ass. So I just decided to write a little simple CSharp script here in my Visual Studio, which will basically read a file, the data source, Fred data sources, text file, and then just iterate through those URL sources and use those for, let me see if I can find our little source file. Where's my recent? Nope. Oh, no, there it is. Yeah, right here. So this would be the typical data sources. I just showed you the text URLs. So I'll iterate through those, and then what I'll do in C#, download that line, that file, parse it up with a slash as the delimiter, and then all it really does is just copies and downloads the file to my desktop. So it's just basically going to name the file. So in my case, just as an example, it will name the file napm.tx. So we'll just take the last token of that delimiter and use that as the file name. Simple stuff if you know what you're doing in C#. So that's how it's done in C#. I'll just run it so it downloads everything as you just saw there, and it will create those text files for me, these guys right here. So as an example, in that industry PMI, the NAPM this is what the file will look like when it downloads and creates it from the C# application. Woo, okay, cool. Okay, so what we've done there, if you come into my MATLAB, let me just clear this workspace here. Oh no. Okay, never mind. Let me just show you what we could do here. So I've shown this before in the European file generation. Oh, come under import data, you'll find, so let's say I'm going to stick with the NAPM. What will happen is when I import that file in my MATLAB, I can, again, I've shown this before, and what it's going to do, it's going to only focus on these data points, the date and the value. So it's going to eliminate all the column header stuff. And then what I'm going to do is I'm going to import into, I think it's a cell array, and then you can import it as such here in the workspace, and that works fine. But I didn't quite use that methodology. What I did was, let me just go back to my import, just repeat the process. So let's say I import, but not only that, but I've also created a function. Okay, so here's the function in MATLAB, mscript. Here's the file name, what's my starting row and what's my end row. And it just downloads the data from the generated code. I've shown that numerous times. So what I've done was, I've got that generic import code, and at the end, what I've also done is I've also enabled to plot the data. So it will convert the cell, the one I just created, in this case NAPM, turns it into a matrix, extracts the rates, which is really the values, and the dates. And even though the the dates are in string format, what I do is I basically convert them into the serial date form, which is really a long or a double. And we turn that into a time series, and then we pass it off to that same Euro time series and plots it. And I also pass through a title. And then what I've got is I've got a client application or a little script that will run each report for each data set. So I have the NAPM, I have the insured unemployment, and then the starting row, the ending row, which is of course 21 and then infinity, and it does that for each data point. So let me just run it, and you'll see how fast it is. To do this manually would take a while. That's why I like importing. So in my case, I'm just going to run this process Fred script. And off she goes. It's going to generate each chart, each plot, and then it's done. So let's go through the plots. All right, so let's start with the University of Michigan. Okay, this is the consumer sentiment. I guess I'm no analyst really, but as you can see, consumer sentiment was a lot higher back before in the late 90s. It's starting to make its way up, I guess, so that's a good sign, but you can see it's dropping off here. Now again, I can always just focus on the, let's say, last year, let's say, and with the dates, but again, I'm just being lazy for now. I want to get this thing developed as fast as possible, and then revisit everything and retweak and calibrate and manipulate the code to be a little better in the plots and analysis and all that sort of stuff. So we have the unemployment rate. Of course, this is reflective of when the unemployment rate hit nearly 10%, and it's working its way down to probably around 6%, which is, give it, I don't know, a little time before it starts to hit the new lows. But you can see after World War II, it did hit the lowest low of around 1%. So That is now plotted. Well, let me see what else we got here. We have the manufacturing total inventories. So what this can be really used for, again, this is all a bit like each one of these is basically the business cycle. So it's not exact. If you were to use Fibonacci or something, you couldn't really predict when durable good inventories are going to spike up like here, based upon business cycles. But you can definitely see consistent patterns throughout. And you can see it's not hitting its low. Things are getting manufactured, but they're just pretty well where you would see. But you could probably develop some kind of little model to better forecast this and over how long, because definitely have the patterns here. So there's that. This is the goods, durable. This is the funny thing is, I've seen this numerous times. Here we're in September, you can see this sudden spike in August. No idea why that was. I'm still baffled by it. Why would a bunch of manufacturers just suddenly start manufacturing like crazy, and then it just suddenly tapers off the next month? And that is not a bug. That is from Quandel shows it. The actual raw reports show it. I have no idea. But it's a signal of something. So maybe here's what I'm thinking. Maybe the ISM are signaling that maybe I'm sure I could read it somewhere qualitatively on what's going on here. But my guess would be maybe they see something we don't see, where manufacturing will just suddenly die off. So they're just trying to manufacture as much and have on hand and whittle it down as manufacturing slows down on a global level. That's my only hint here, because you can see this sudden drop in '08, so maybe that's a sign of something. As you can see, historically, it's never been seen before, but I don't know what that will signal forecasting wise. But it is an interesting data point. All right, so there's that. We've got the money supply. This is what the government supplies, liquid, and basically the liquidity of the total U.S. economy. So it is pretty liquid. This to me is just the equivalent of federal debt, really, and the market will do quite well. There was another interesting source that was listed yesterday, my webinar on how much the U.S. government will spend each day from the taper, which will obviously impact the market the next day, just due to the fact of that just shows the liquidity into the equity markets, which can be used and show a direct relationship between these type of figures and the performance of the U.S. stock market, because the liquidity provided by the Fed means better economy, equity market. So do keep in that mind. But this is a lot of, probably since around here, 90, all this is pretty well artificial. That's just quantitative easing at work, which means it's not real economy or economic activity. That's just inflated by the U.S. Fed pumping in U.S. dollars that they print, which again is U.S. debt, not a good thing. Anyways, enough of that. Let's talk about the ISM PMIs, the industrial supply of the PMIs. So these, again, business cycles, how it goes up and down, up and down, up and down. The interesting thing is, up until when people started outsourcing, you can see it hit up to 70, which is peak you'll ever see. But ever since, it's never gone back to 70. That's sad, because that's now China at play, and that's why the economy is pretty well dead. Well, not dead, but not as, since 1948, you can see it went all the way up to almost 80, 70, 70, and then once outsourcing hit, the economy activity is just pretty well not as strong as you would want it to be to hit those marks of 70. Still doing okay. Anything over 50 is considered growth and expansion. anything below 50 is considered recessionary. So we got close a couple of times here, and this is one of the metrics you want to keep an eye on for contraction versus expansion with the U.S. market, which obviously greatly affects stock performance. So there's that. I think unemployment, which is good here. I don't know exactly the peak here, but I'm gonna probably 2008, obviously, and they've whittled it down. Again, no economist here, but all these jobs that are created to bring down the unemployment is just due to the fact of there's no manufacturing jobs, so those manufacturing jobs don't pay as well. These are probably low-level service jobs that brings down the unemployment. Not good quality jobs, which means a lot of people don't have disposable income to spend money in the economy, which again is not a good thing, and that's why the economy is still pretty well flatlined, which is a shame. Anyways, that's the way I look at it. And I think we got one more. Oh no, we got two more. Industrial production. Production's pretty good. It's continuously growing, which is good. Now, the other charts that I showed you, namely the manufactured total inventory, manufactured new goods. This does not include transportation, specifically airline, which does really well in the States. So that is discounted because if I include or focus on that type of manufacturing, that's going to skew what's really going on in the economy. So this industrial production index does include bigger, more, I guess you could call it successful manufacturers like airline, like Boeing, let's say, do really well. But these other ones that I showed earlier, again, does not include those type of industries because you want to get a better reflection what's really happening, taking out those stronger manufacturers that can typically skew those type of charts. Okay, so there's those, and then we have the consumer durable goods as well. So that is an example what I just showed here. So what we're doing is that will include airplane manufacturers, which is the big part of the U.S. economy. Again, Boeing. But when you factor in the real economy, which is consumer durable, you can see it's dropped. And I don't know at what point, but I can see that in the raw data. So it's bounced back, and it'll probably come back down later on because, again, this is all cyclical, as you can tell. And if there's a way to forecast that would be awesome. You really can't use. I just don't see how these guys using Fibonacci can predict these dips because they'll come, but you can. I don't see how you can properly forecast those exact moments when they drop at which month. But combined, you could probably get an idea. So again, hopefully enough of my Jim Cramer analysis. That's the total cycle of how to get a measurement of the U.S. economy and be able to add the potential trading opportunities and ideas that you can generate from these charts. So I'm going to do a go at that and see what comes up, and hopefully see you in the next video at some point. Talk to you later.